Today is Thursday, June 6th. We are now live with the latest in the crypto world. It's 7 a.m. in New York City, 12 p.m. in London, 8 p.m. in Tokyo, and 1 p.m. here in Malta. We have our crypto experts, Jason Fernandez and Kevin Mirko, on today's show. But first, let's take a quick look at some of the market indicators. The cryptocurrency index CCI 30 hovers just over the 4,100 point mark. It has declined by nearly 10% so far in June. However, the index remains 90% in the green year to date. The 30-day Bitcoin volatility index rose above the 5% mark yesterday for the first time since December of last year. Trading activity has slowed down. The CoinMarketCap website's 24-hour traded volume indicator has moved south of the $70 billion mark. The Messari website's real-time volume measures at just slightly more than $2.1 billion. The Bitcoin dominance indicator has remained virtually unchanged at slightly less than 56%. Its most recent peak of more than 60% was posted less than a month ago. The top 5 digital assets mostly show no significant moves. Bitcoin has stayed close to the $7,800 range. The $240 support level has held for Ether. XRP traders are once again engaging in the battle at the 40-cent zone. Bitcoin Cash faces some resistance at the $400 range after slipping south of this psychological level. Litecoin holds the ground above the $100 mark to remain the 5th coin by market cap. The Coin 360 heat map shows a generally mixed picture, but most of the gains are rather insignificant. According to the token spread website, the biggest intermarket price difference is just 1% today, and it is between the CEX and the BitMEX exchanges. The largest buy and sell side difference is on the XMO exchange, and it is 0.41%. Now let's move on to take a look at some of the characteristics of a blockchain project, and today it's IoTex. It is a privacy-centric blockchain platform that looks to power the Internet of Things. This is achieved by building a decentralized trust fabric that consists of multiple blockchains to connect humans, machines, and of course applications. The platform's token trades with the ticker IOTX, and its price peaked at nearly 9 cents in June of last year. And as of today, it can be purchased for just slightly more than 1 cent. We will now review the performance of various cryptocurrency asset classes, as grouped, of course, by the Messari website. The infrastructure group posts an increase of 0.5%. This is despite Ontology and Neo being the only major assets in the green. The media and the entertainment category is virtually unchanged as it stands a fraction in the red. This category shows an overall mixed performance. The financial sector is the top performer with an increase of 1.3%. It is largely driven by Chainlink that is up by double digits. The currency category has dropped by slightly more than 1%, and Bitcoin SV is a major bearish factor today with a double-digit drop. And lastly, the services section posts a decline of 0.3%. This is where the 5 major cryptocurrency categories stand so far this Thursday. Now, before we head to a short break, we will leave you with an overview of the most significant moves among the top 100 digital assets. There are both significant increases and drops. Let's take a look.
different countries all around the world, which makes us grow in like a sphere.
We are stronger than ever.
Have these questions answered without disclosing anything.
AI field is mostly controlled by a few large corporations.
Much busier, bigger than ever.
In the mid-2020s. I do think that will come.
We should kind of keep in mind that we want the world to be a better place.
$15 billion a day. This is incredible.
People find a way to create infrastructure.
I think knowledge is one of the most important things in the world.
We laid the foundation for the distributed trust model that Satoshi builds on.
It does come with some risks, but at the same time, I think it's an opportunity for countries.
Individuals miss the boat on a market, they miss the boat. When the institutions miss the boat, they bring the boat back.
This is Blocks Live TV.
And we're back with Kevin Mirko, the CEO of the Coin Metro Exchange, and Jason Fernandez, COO and co-founder of AE Token. Guys, great to have you. How are you doing today?
Excellent, Leah.
Good, good. Now, Kevin, we'll come straight to you first. Crypto markets have stabilized after declining earlier in the week. So is this stability a good sign?
Sure. I think we talk about this a lot on the show. When people see markets shoot up by a few percent a day, they start to get very ecstatic and talk about how Bitcoin's going to be 2 million in a year. And when they see the market do the reverse, it's the exact reverse. That now the market's going to hit 1,000 in the next 3 weeks. Everybody should sell out of Bitcoin, et cetera. So I think overall, when you start to see ebb and flows of markets, that's profit taking. That's signs of profit taking. That's signs of people influxing money either between micro caps, like let's say tokens in this example, into macro caps like Bitcoin, like Ethereum, et cetera. And that ebb and flow starts to exist more and more. You're starting to see the market maturing. It's maturing literally in front of our eyes. Markets can't have moves, one-sided moves for months and months on end. This is not something that mature markets can handle. Mainly because as participants mature, they learn that profit taking is part of the game. They learn that they should be probably on both sides of the market, especially if they're speculating. They shouldn't sit on one side. So that's why we start to see these ebb and flows. So we're starting to see more mature market movements. The markets are starting to be affected more and more by substantial news and not just by just any hype, anything that comes out on Twitter or anything that comes out via any other types of media. You're starting to see the market really just be affected, at least the macro market. There are specific, smaller cap tokens that can be affected by very small, print or very small media. But overall, I think all of this is good for the market. It shows us that the market is maturing, that the participants are maturing, and that it's starting to mimic more mature markets, whether that be equity markets or even larger markets like bond markets, for example.
Okay, so clearly a very, very positive sign, especially in terms of that maturing market that you say we're beginning to see. Now, Jason, do you equally agree? Is this a good sign?
I think so. It's important to realize that the 30-day moving average had served as a strong support throughout the rally, and that goes back from early February when the lows were at 3,500 to the recent high of 9,097 when we just touched that. And essentially, Bitcoin was creating multiple bullish higher lows along that line over the last 4 months. That changed on Tuesday when the short-term outlook essentially turned bearish, and that's because it was the first UTC close under that average since February 8th. And also widely tracked indicators at the time were sort of showing a change in favor of the bears. But just a couple of days later today, and I think there are a lot of reasons to be positive. One is that prices have not just stabilized, but have actually recovered somewhat. So they dropped down fairly significantly, but now it's almost back up to 8,000. It's just 7,800, 7,850. I have no doubt that we will cross 8,000 soon. I agree with Kevin. This does then, it shows you right there that this is basically normal ebb and flow, and you're not going to have an asset that goes up basically forever. And any hopes that the bears had that Bitcoin would be in a free fall just didn't come to pass. It dropped, but there was so much support that it pushed it right back up, and it's at 7,800 now. So I think overall that's a really good sign.
signs of a healthy market, especially because prices have recovered, as you have said. Now, Kevin, we will go back to you. We did speak about the battle between KIC and the SEC yesterday with my colleagues. So this is obviously something that is going to develop and perhaps actually even set an important precedent for the space. So where do you see this case heading?
Well, I think it's kind of a slam dunk for the SEC. I read over the case, the filing that they submitted. To be honest, I've talked about this not just here on this show, but I think 2 years ago I was talking about how U.S. law tends to follow what that's intended to follow. This is how U.S. law works. Basically, you have regulators that are there to enforce legislation, but they don't write legislation. Lawmakers write legislation, but lawmakers generally don't write legislation based on nothing. They write it based on precedent, usually judicial precedent. So they wait basically for prosecutions to happen, for judges to make decisions, and then they write legislation based on the judge's decision, and then the regulators are tasked to actually enforce it. So this process was always going to happen. I guess, unfortunately for KIC, they are one of the first major cases that we've seen. Obviously, there are guaranteed file folders inside the SEC, probably quite large ones, on various companies inside of the crypto sphere. And we will start to see more of these litigations happen, whether it be criminal prosecution or whether it be civil prosecution. The SEC also, this right now is civil. It's civil first. It's always civil first. They're always going to go after the low-hanging fruit first. If they win the civil case, watch out for criminal charges. I do think, though, it's a slam dunk. Basically, the problem with the U.S. law is it's simply that if you're selling a security, even if you market it as it's not a security, it's a security. Done. So if you break the Howey test, even if you don't talk about speculation, you still broke the Howey test, it's over with. However, even if you remain in line with the law, but you simply put out a tweet, let's say, that says, we're going to induce demand on our token, which is going to make it worth more money. You should invest now because you're going to make a profit. Even if you're selling footballs at that point, or whatever, straws, doesn't matter. It's a security. You are breaking securities law, and you will lose that case. So I think it's a slam dunk. I think they will lose, unfortunately and fortunately for this space. I think, again, this all goes to part of maturity. Crypto wasn't the first financial industry that gets hit by these type of lawsuits. It's not going to be the last. It's kind of almost like a rite of passage. This is going to happen. Now that it's happening, we're one step closer to getting to some actual legislation in the U.S. that will actually should, at the end of the day, help companies align their frameworks, align their how they do their business, so that they don't get hit with these type of lawsuits in the future. I think overall, though, from let's say price perspective for their own token, who knows? But when it comes to the overall macro market, I don't expect it to have a huge impact, mainly because everybody in the space already knows that the U.S., the SEC, the CFTC are not to be bleeped with. And this is just showing you that what everybody thought was true is pretty much true. So I think most of this news is priced in, per se. Maybe not specifically on the KIC token, that's for sure, but overall market has been priced in for quite some time.
Okay, but definitely a slam dunk, as you say, for the SEC. And I guess, in your opinion, we can actually expect to see more litigations going to happen. So, Jason, equally, do you take the same view here? More litigations, can we expect it?
Yeah, I read the document again, also the one that was filed yesterday or a couple of days ago by the SEC. And some of the points they make as criticism are actually par for the course when it comes to ICOs. That said, it's unlikely that any one or two factors would be determinant, but it's probably the totality of the circumstances that are considered. And when you consider the totality, as Kevin said, it is pretty damning. There are quotes from KIC officials literally saying that if people buy now, they will benefit when the prices go up. They've used the word "you will make a ton of money" several times. The words that seems, like a really, really bad judgment call at the very least. And also, their product wasn't even ready when they started selling the token, which indicates that there was no actual utility benefit. There was no actual utility for those tokens. And actually, their advisors pretty much advised against it. I mean, they did say that one of their risk factors was security. So this is on the horizon for them. I mean, I'm surprised that they weren't a lot more careful about the language that they use. I mean, they basically made it easy for the SEC. It's not just, I mean, like Kevin pointed out, it's even if you were to not market it as a security, if it is a security, or if you say something like, "Hey, buy it now and it'll go up," that makes it a security, and that means that they'll probably come after you. But they actually, I mean, they practically market it as a security. I mean, certainly internally they market it as a security, which to me sounds like terrible judgment. So yeah, it does seem like a slam dunk case for the SEC. And yes, I do see that this will probably expand. There's probably a bunch of other companies, just like a list of other companies that the SEC is going through that will soon see enforcement actions like this in the near future. And like Kevin said, yeah, it's something that one can expect and basically is an indication of the market growing, but it's obviously no joy for the people that happen to be running those ICOs.
Absolutely no joy there at all. Now, access to the Binance exchange will be limited for a number of countries from the 1st of July. This is actually according to a screenshot shared on Twitter. So some even actually speculate this might be a result of the trade wars between the US and China. So Kevin, what are your thoughts on this?
I wish we could. I wish Binance might want to blame Donald Trump for this one, but I don't think they can, unfortunately. This has nothing to do with the China-U.S. Trade war. Sorry for the dog barking in the background, but our mascot's in the office today and apparently having a bad day. So somebody will quiet that guy down in a second. Point is that the reason is I tend to speculate. This is speculation on my part, but I tend to speculate that we saw local Bitcoins stop cash transactions, not just in the U.S. but globally. We've seen we have Bitfinex obviously that's also stopping, making sure now finally that they don't have access, they don't have residual, let's say, touches into the U.S. You're starting to see this happen more and more, and I tend to think that there's been a lot of cease and desist and, let's say, verbally abusive letters that have been sent out probably by several arms of the U.S. government to different exchanges and different counterparties around the world. And I think those letters, and I've seen some of those letters, I've seen how they're redacted, and they can be quite scary. And generally, they carry the weight of the U.S. government behind them. So whether you don't think they're scary verbally, they're still pretty scary. And I think we're starting to see reverberation. I'm pretty sure there's like I said, there's a Binance archive somewhere in the U.S. government, whether that's at the SEC, the CFTC, or somewhere else. That's probably massive. I mean, literally, if it was a paper file, it'd probably be the size of a room. It's probably a disk drive. But I guarantee you there's a file somewhere. And I think they probably got approached. And because they got approached, they quickly took action to make sure to mitigate at least some risk that they're going afoul of the U.S. government. They obviously have U.S. exposure. They've had U.S. exposure since they started. They're allowing access to tradability of tokens that are considered securities by the U.S. government. They were allowing deposits with no KYC from U.S. participants, basically money laundering. The amount of issues that they could face from the U.S. government is staggering. So I think basically what it is, it's either the U.S. or it's FAFT, which is basically the long arm of the U.S. government, regardless how anybody dictates it to you. And I think either one of those two entities or country or entity has reached out to these exchanges, and that's why they're all starting to move. And I think we're going to see this as well. I predicted this years ago. It's finally starting to happen. Whether you're a decentralized exchange, a centralized exchange, you can't get away from compliance, and you definitely can't get away, especially from key regions of the world. The U.S. definitely has a long arm. So do other countries, though, however. And I think the U.S. trade war, I think that's a ridiculous assumption. Honestly, right now, that's kind of just a theater. It's a theater and it's a show until something actually happens. We'll see who actually comes ahead on that theater. But right now it's theater. This is not theater. This is definitely a threat. And I think they were threatened in one way, shape, or another. And that's why they acted.
Okay, but definitely something to take seriously there, as you say. Now, Jason, do you also have a similar opinion?
Yeah, I agree. It's more than likely that this action has come out of some degree of threats that they've received either from the U.S. government or from other governments. And yeah, this is going to affect a lot of other exchanges as well. And it was a matter of course before it happened. Everybody expected it to happen, so it's not a total surprise. As Kevin pointed out, yes, Binance does list basically tokens that the U.S. government would consider securities. So it's a serious issue and something that they obviously want to protect themselves from. One of the points that CZ has made is that the GeoBlock only applies to a single website, that's Binance.org. And Binance decentralized exchange itself is not blocking users based on location, because really they can't. They cannot enforce a regional ban on users, and it's really up to the providers that operate on Binance DEX to make those independent decisions about who they allow access to the services. So outside of Binance.org, users are still able to effectively use Binance DEX by using other platforms like Trust Wallet to trade crypto assets, and that would be using the native coin swap features. But yeah, I mean, there are ways around it, and certainly this has happened. This is more than likely to be a result of some degree of threatening from a government entity or regulators.
Just to put a point on that, Jason, and that actually adds significantly more risk to Binance as an overall entity, mainly because, like I said, decentralized exchanges, you're right, from a protocol standpoint, it's very difficult or almost impossible, especially from an IP. But that DEX will need to require at some point KYC on those participants, and that's where they're going to find out, at least to some extent, where these people are from. But the fact that it's not easily fixable actually puts more risk on Binance itself, because I guarantee you, if they did receive a letter, that the regulators in the U.S. have already starting to think about, if they say they can't turn it off, that doesn't mean they're just going to say, oh, okay, then it's fine, go ahead and run it if you can't turn it off. They're going to have to find a way to mitigate that risk as well, and that's much more complicated than just an IP screening, for sure.
And we'll have to wait and see, as you say, how they actually managed to do that. Now, just moving on, the HODL exchange, and we do actually have the CEO coming on the program with us tomorrow, so very much looking forward to that. And the exchange has actually launched Bitcoin trading on the Lightning Network. So, Kevin, Jason, we're going to go straight to you. Is this one of the technical solutions that could be the future of cryptocurrency trading?
Yeah, I mean, it's an interesting concept. I mean, HODL, you have like a four-step process. It starts when the contract is created between a buyer and a seller. After this, the seller essentially deposits those Bitcoins from his or her Lightning account, Lightning wallet rather, and then the buyer pays the seller via whatever they agree to upon payment method is. And then the final step is basically the seller releasing the Bitcoin or whatever it is directly to the buyer's Lightning wallet. The only difference between the way HODL is doing it is that for the contract lifetime, essentially HODL are the ones that hold the funds in their Lightning wallet, and essentially that's the theory is that it's supposed to protect both the buyer and the seller from fraud and scams. So the idea is that certainly using a system like this will make trading much quicker and faster. I mean, basically trading Bitcoin back and forth, or cryptocurrencies back and forth locally much faster, and obviously lower fees, but that does introduce a certain aspect of centralization to it. But it just depends on how HODL decides how transparent they are with how they decide to implement it.
And you mentioned there that the key point, I guess, really is to protect the buyer and the seller from scams. So, Kevin, let's hear your thoughts. Do you think this is going to be the future of trading cryptocurrency?
I think it's a step in the right direction. But this specific Lightning Network, no, I don't think so, at least not in its current iteration, mainly because you have limited capacity for one, because the Lightning Network requires 100%, well, basically in order to do anything on the Lightning Network, you have credit on the Lightning Network, which means there's limited capacity for how much assets can move through the Lightning Network based on the credit that sits inside the network. You have some insecurities. You have to have your keys online, for example. For Lightning Network, I think that we're generally going down the right path. I think the future of not just crypto, but any tokenized asset trading is going to be a hybrid of complete centralization and complete decentralization. So basically a semi-decentralized mechanism, because in regulated finance, you're always going to find a little bit of centralization. At least in modern finance, pretty much everything's centralized. But if you look at regulation, if you look at oversight is governance is centralized for the most part. Now, obviously, there are people working on protocols that can even have decentralized governance. But at this point in time, I think that we're quite a way away from that. So I do think that it's headed in the right direction. I don't think Lightning Network will become the solution. I think right now it's one of the only solutions where something like this could be built. So in terms of that, I think they probably made the right choice. It is one of the networks one of the protocols that's getting most attention, and they're investing a good amount of money to improving on 3 or 4 major, I'm not going to say major, the flaws that exist within the Lightning Network. But yeah, I don't think this is a solution, but I think it's a step in the general right direction for crypto and asset trading in general.
Okay, so a step in the right direction, which is what we like to hear. Now, Jason, back to you. A new report by Chain AI reveals that bots made the majority of transactions on EOSD app. So does it mean that this and other platforms are used by less people than actually expected? And is this something that we simply have expected and can start to expect to happen more?
So similar to how the internet is suffering from content scraping bots, the crypto businesses are basically inundated with a wide variety of bots, and that basically makes it difficult to distinguish true business metrics and true business stats from manipulated ones. So generally, in this particular analysis that they did, they figured out that the top 10 EOS gambling dApps, by studying essentially the top 10 EOS gambling dApps, they found out that 51% of unique accounts and 75% of transactions, so roughly equivalent to $6 million in daily transaction volume, was ascribed to bots. And obviously that's really not something you'd want, because basically a lot of new blockchain protocols are determined on being able to figure out whether whether looking at the statistics about transaction speeds, transaction amounts, all these other things. So the fact that that this sort of data is manipulated is not a good sign, and it's not going to be easy for anybody looking at the protocol to figure out if it's being successful or not.
Okay, so not too pleased that you don't think that it's going to be a good sign. So Kevin, what are your thoughts for us, please?
I think it depends how you look at it. I think what Jason mentioned is definitely not a good sign. However, we talked about maturing markets, right? So if you look at least from a perspective of almost every other industry, as mature industries mature more or become more mature over time, they generally go into automation. The problem is that when you set that automation bar too low, I don't know. I got a little feedback there. I don't know what that was. Anyway, so when you set that automation bar too low, and anybody can kind of create bots, and we're talking about bots that may be used for nefarious purposes, maybe they're used for just standard purposes, whatever, but they do create a lot of junk data. And when you're building a business and business metrics, like Jason mentioned, based on data, and you have junk data, well, then you're probably going to build junk metrics, which are not going to actually give you information that would make your business succeed. So I think it's bad and good. I think it generally shows that there's interest. There's definitely interest out there from people that are creating these bots to put them on the EOS network, which is a good thing. I think, but generally speaking, while that shows a bit of maturity, meaning that there's more eyes on the market, meaning that people are trying to do things to make this market move forward, it also shows that the bar is set a little bit too low. That means that generally speaking, there needs to be, kind of some type of access control to who can have access to actually create specific types of bots. And then again, how somebody on the other side is actually taking those metrics and compiling them. So anyway, these things take time. But I think generally what we see now is not good news, but it's leading us toward, let's say, the light, to where people will be able to create things that are meaningful to them and actually use them inside of these protocols, which is generally a good thing.
Kevin, Jason, thank you so much. Unfortunately, that is all we have time for today. But as always, it's been an absolute pleasure having you both on the line with us. Thank you.
Same to you, Leila.
Now, before we sign off, I do have a last-minute update from my editorial staff regarding the crypto market. The total market capitalization has shown no significant moves as it stands near the $250 billion mark. Trading activity remains slower than in recent days, and the coin market cap website's daily volume stands at just under the $70 billion level. Bitcoin SV is the top mover among the large caps with a double-digit decline. That is all for this Thursday's Crypto Now live show. We thank Kevin and Jason for the expert analysis. We thank the audience for joining us and invite you all to accompany us every weekday at the same time.